Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Namaskar. My name is Shishir and I write on micro and macro economy from New Delhi. Welcome to the new episode of State of Economy, and I am joined with Rajani Sinha, Chief Economist of CARE. Rajani, we saw a number of data on May 1. GST collection at all-time high. We saw almost most of the passenger vehicle sale. Most of the companies reported double-digit growth. Then we saw a record number of people flying on domestic sector. Then another numbers were about the PMI Manufacturing. We saw a 4-month high. If I ask you about the GST collection, rupees 1.87 lakh crore, which is all-time high, of course, there are three elements which are always given as a reason for high collection. One is, of course, the compliance. The second one is, of course, the consumption. And the third one is always said as that the recovery in the economy. If I ask you, what are the key factors which have contributed in rupees 1.87 lakh crore? These three factors or any other factor which you think?
Hi, Shishir. Happy to be a part of this show. So, like you very rightly pointed out, we have been getting very good economic indicators, high frequency economic indicators. Now, talking specifically about GST, yes, the GST number has been very good. So, one thing I'll highlight before I go into the details of this number is that in the month of March and April, generally we do see higher number. We do see an uptick sequentially. So, that is also something that has contributed to this rise. But having said that, overall, if you see not just the last month data, but overall the GST collection has been pretty robust for the last 13, 14 months. And it's a combination of the factors that you just pointed out. Better compliance, pickup in the economy. We are seeing a recovery in domestic demand. There's still a lot of pent-up demand. So it's a combination of these factors which has resulted in high GST collection. Domestic demand is still pretty strong. Though we are anticipating that eventually over a longer period of time in the next few quarters, we will see some of the pent-up demand waning. But so far, we are not seeing that. So I would say it's strong domestic demand which is contributing to this. And along with that, yes, prices have also been high. So that has also contributed to the GST collection being high.
One trend which we have observed that all the high-end products are being sold in a large quantity. And since we know that the GST rate and some of the products are also attracting cess, do you think that when we talk about the GST collection, the demand for high-end products are much higher and the demand for the entry level or what we call as the mass product is slightly on the lower side? Do you agree with this kind of assumption?
Yes, most probably that's what something which would be happening, because we are seeing that in all the sectors. You talk about consumer durables or specifically auto sales, we are seeing that high-end segment is doing relatively better than the mid-priced or the low-price segment. And this is something which we have been observing, in fact, in the last 1 year, that post the pandemic, the recovery that has been happening, it's broadly what we've been calling as the K-shaped recovery. It's one income category which is doing very well. The demand from that category is pretty strong, and hence the premium segment is doing very well, and that would also have contributed to this high GST collection. So yes, I agree with this assumption.
Okay. Now, when you talk about the K-shaped recovery, that means when we talk about high growth or when we talk about high GDP number, that means inclusiveness in that number is missing. So that is one thing which we should be worried about.
Yes, we should be worried about it. But I think, given the situation in which we are currently, all the economic uncertainty, not just in India, but globally, what we are going through, I think first it's a respite that growth is happening, domestic demand is strong. Though I agree that it is concerning that it's the higher end segment which is doing relatively better. But even if we look at the lower segment, the lower income category, demand originating from there, it is showing slight improvement. To give you an example, if we look at RBI household survey on household spending, So if we look at that, that gives a broad reflection of, what's happening, not just at the premium segment, but also at the mass segment. And there, what we were seeing is that the masses were mainly spending on essential items. When it came to non-essential items, the consumer spending was, in fact, contracting. But in the last few months, what we are seeing now is that the spending on non-essential items is also picking up. So I think the lower income category is also slowly getting more confident about economic recovery. And eventually, going forward, we are likely to see a pickup in demand from that segment also. But so far, yes, what you said is correct, that it's the higher segment, it's the premium segment which is driving India's economic growth. And that is a little worrying.
Now, coming to the demand component, when we talk about the overall demand, of course, the urban demand is picking up, but the rural demand is not seeing that kind of growth. How do you read this number, or what do you have to say on this?
So yes, this is also kind of, reflection of the K-shaped recovery that we spoke about. So in terms of rural-urban divide also, we are seeing that. So one big reason for consumption, not picking up as strongly as we would have liked it to, has been high inflation in Indian economy, which had been making consumers more cautious and wary of their spending. And that's also reason, and CPI inflation was higher in rural area than urban area. And that was having a strong bearing on rural demand. But going forward with the expectation that inflation is going to moderate, we are likely to see an improvement in rural demand. There are some signs of that already happening. If you look at the corporate results of the FMCG companies for the last quarter that has been coming up, the FMCG companies are highlighting that while rural demand is still weak compared to the urban demand, but it has started improving. On volume basis, they are seeing an improvement in rural demand compared to what it was, say, 2 quarters back. So it is improving, but yes, it's still lower than urban demand.
Okay, now coming to the inflation, we have seen that inflation has come down from the what we call as the upper tolerance level of 6%. Now it is 5.7%. The other thing which is giving some kind of worry on the inflation front is one, unseasonal rain. Another one is the OPEC plus production cut thing. And the third one is, of course, the geopolitical situation. Now the next inflation number will be out on 12th of this month. How do you read that number? What kind of projection you have?
So, Shishir, we are expecting that inflation is going to go down further from these levels, at least in the next few months. And one big reason for that is the base effect. So, broadly, in the first quarter of this year, fiscal year, we are expecting inflation to fall to around 4.8%. And as I said, base effect will have a big role to play here. But otherwise, the big concern would be, what happens in terms of monsoon. That's something which is concerning at this point in time, especially because food inflation had a big role to play in our overall inflation. So food inflation has contributed more than 40% in the last few months. If I see, cereal inflation is very high, milk inflation is very high. The last data point that we had for inflation, we did see cereal inflation going down a little bit, but it's still high at around 15% or so. Like I said, milk inflation is very high. So in the given situation, what is concerning is food inflation has a strong bearing on inflationary expectations, which in turn can further push up core inflation. So we wouldn't want food inflation to again start flaring up. And that is where the concern is that if the monsoon doesn't turn out to be normal, which is a concern right now with this whole projection of El Nino, that would be concerning. So I would be most concerned about, the impact of monsoon, and also on, what you spoke about, crude oil prices going up or any other commodity prices. Broadly, I would say when I speak about global commodity prices, right now, unless there is any further supply side constraint, I feel that it wouldn't be a big concern because overall we are likely to see global demand going down, and that would kind of put a cap on global commodity prices. But as far as domestic food prices are concerned, I think there is a risk of El Nino and impact of that on monsoon in India.
One important factor which gets normally very little space in newspapers, especially when we talk about inflation, that is the milk inflation. Nowadays, we are discussing about milk inflation in slightly explanatory way, but still it is not getting that space. What kind of concern you see? Because people are saying that if we think about the fodder, if we think about the other inputs or the other raw materials for the milk, that is not giving any kind of comfort. And milk is also important from various other sectors, like when we talk about ice cream or when we talk about the chocolates or the other products. So, how do you see the milk inflation panning out at this moment?
So, milk inflation will be a concern going forward. Overall, we don't hear much about milk inflation because the weightage of that on CPI inflation is not very high. But like you said, it has indirect impact because it will impact other food products, milk inflation going up. And the other components of food inflation is quite interlinked. So if the cereal inflation is high, it would have an impact on the feedstock prices, and it would have an impact on milk inflation. So overall, inflation is interlinked. And I would say milk inflation does have an important role to play because, as I mentioned earlier, the food items, specifically, items like cereals, vegetables, milk, they have a strong bearing on household inflationary expectations. So it's not just the direct impact on inflation. I'm also concerned about the impact it will have on household inflationary expectations. Right now, if we look at that data on household inflationary expectations, it has been going down. But if we see a further flare up in vegetable prices, or if milk inflation remains high, it would have a bearing on household inflationary expectations also.
Now, coming to the WPI versus CPI, there's always a debate between these two indicators. We have seen WPIs going down much faster than the CPI. Do you see that the impact of down in WPI will have impact on CPI also, apart from the base effect which you mentioned, and apart from some other factors which are going to help in bringing down the CPI? Do you also see that the impact of WPI on CPI in, say, next 3 to 6 months?
So, WPI inflation, the fall is in fact likely to be sharper than what we are going to see in CPI inflation. A CPI inflation overall, we are expecting average of around 5.1%, broadly similar to what RBI's expectation is. RBI is talking about average of 5.2%. Whereas if we look at WPI inflation, we are expecting the average to fall below 4%. So WPI, the fall is going to be more. And the main reason for that is that CPI inflation has a large component of food, and food will continue to remain a cause of concern. But overall, like you mentioned, with WPI inflation going down, that would have a moderating impact on CPI inflation also going forward. So apart from base effect, the fact that WPI inflation is likely to go down further, the fact that overall the monetary policy, the rate hikes that have happened so far, that will also with a lag start having an impact on inflation. The fact that we are expecting some moderation in domestic demand also going forward, as there is some waning of pent up demand. So all these factors should also contribute to CPI inflation going down in the months to come.
Okay. Now, when we talk about CPI, the ideally RBI would look for 4% median rate. I mean, that's the normal thing which they always wish, but it is always a wish. It cannot be fulfilled given the consideration what we are facing. Now, when the Federal Reserve is going to increase the rate, and we are expecting that the MPC in India will go for pause at least for 1 or 2 more cycle, and then it can think of raising the rate. Do you think that the Federal Reserve rate hike will have a larger impact on Indian economy than the MPC going for pause?
So, as far as MPC's decision is concerned, I think while MPC would obviously be watching very closely what's happening globally and what's the decision taken by Fed, but broadly, market has factored in that there will be more rate hikes by Fed. whereas the central bank here has very clearly indicated, reiterated that they would be focusing on domestic inflation situation. And as long as that is manageable, they will make their decision independent of, the decision taken by Fed. So I think what RBI will be closely monitoring uh, is the growth and inflation dynamics in here in Indian economy, and less so by what the decision taken by Fed. Because what has happened is that over here now there are concerns on the growth front. We are concerned while the high frequency economic indicators which you spoke about initially, they are looking good. But there are concerns that if the global economy is slowing, that will have an impact on Indian economy. And moreover, there are a lot of uncertainties around global commodity prices, around the monsoon situation here. So, in this given situation, RBI would be cautious on whether they don't overshoot in terms of rate hikes, because the real rate of interest in India is already high compared to what we are seeing globally. So, in that situation, the focus will be here on growth and inflation dynamics. And in fact, if you look at the external sector front, there is some reprieve for India at this point in time. Because even while exports are not looking good, exports are contracting. If you look at the last few months' data, but if you look at the trade deficit data, the trade deficit is narrowing. The CAD has narrowed. The expectation is that CAD is likely to narrow to, we are expecting in FY23, we are expecting CAD at around 2.1%. And if you remember, just few months back, we were all talking about CAD to GDP ratio at around 3.5% or so. But the situation has turned quite favorable with very strong growth in service sector exports and strong remittances that we have been seeing. And in fact, for FY24, we are expecting CAD to fall even further to around 1.6%. So if you see the external situation is the vulnerability of Indian economy is relatively less. Forex reserves are at good level. Even while we are seeing FII outflows, FDI inflows have reduced, but still, CAD is likely to reduce. Forex reserves are at a healthy level. Overall external vulnerability has reduced with CAD reducing. So in that sense, RBI has got some more room to focus on the domestic parameters at this point in time.
Rajni, my final question to you, what kind of projection you have for FY24?
So the GDP number, we are expecting quarterly number at around 7.8% or so. And so overall, if you look at India's growth story, what we are expecting is that consumption is likely to continue improving. Investment, now, if I look at the pillar of investment, again, it is being mainly led by government investment. Private investment is still not picking up, though we are seeing some signs of that. But the signs are pretty feeble still, and it's surprising because the capacity utilization levels for the manufacturing sector is high. And in the given situation, we should see a stronger pickup in private capex than what we are actually seeing. If we look at the data, some of the parameters that we track for investment, what we are seeing is that the intent to invest by the private sector is showing strong jump in the fourth quarter of FY23. But if you go deeper into the data, you see that, and before I go into the sectoral breakup of intent to invest, it's important to note that the intent to invest is showing a very strong participation from the private sector, which is a positive. But if you go deeper into the data, what you see is that it's very skewed. It's just, transport services sector, because of which there's this big jump in intent to invest in the fourth quarter. But otherwise, the manufacturing sector is still not showing a very strong intent to invest, the private sector, which is concerning on the investment front. And then again, as I mentioned, on the external sector front, we are expecting that this whole slowdown globally will have an impact on Indian economy. Overall, we are expecting exports to contract by around 5% or so in FY24. So in the given situation, what we broadly expect is that we are going to see the growth momentum coming mainly from consumption, domestic consumption demand. And if this momentum is sustained, then we will see some further pickup in private capex, which has not happened so far. External sector demand will remain concerning. But again, here the positive aspect is that we are expecting the service sector exports to remain pretty healthy, which we have seen from the last few data points, and we expect that trend to continue in FY24. So broadly, for the full year, we are expecting GDP growth at around 6.1%. So we are less optimistic than the projection given by RBI, but still we are more optimistic than many other projections in the market, which are talking about less than 6% GDP growth for FY24.
Thank you very much, Rajani, for talking to us.
Thank you.